Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm Paul Curcio, managing editor of ETF.com, and I'll be your host again this week. Today, we'll be taking a closer look at several of the most popular and interesting stories that ETF.com has covered in the past week. Joining me are senior content editor Ken Tooney, senior ETF analyst Samit Roy, and contributing editor Ron Day. Good morning, gentlemen.
Good morning.
Hey, everyone.
All right. ETF news has been coming down fast and furious this week. It feels like a year since we last sat down together, but it's been just 7 days, believe it or not. And what a week it has been. Now, usually Samit Roy has been the host and has the honor of conducting this podcast, but he was on assignment this week attending the Exchange Conference in Las Vegas. But he's back right here with us today to tell us all about what he saw that doesn't have to stay in Vegas. So, Samit, please tell our listeners about the conference. Who was there? What it's for? What did you see? What are your takeaways?
Yeah, absolutely, Paul. Good to be back. So, this was the Exchange Conference, which is one of the big ETF conferences that happens every year. It's been going on for a few years now. It used to be in Miami, Florida. This was the first time that they had it in Las Vegas. The new venue wasn't bad. It's kind of a preference thing, Do you want the dry heat, bright lights, and casinos of Vegas, or the humidity and the beaches of Florida? I don't know. I'm kind of, split on that. I like the Vegas venue. I also like the Florida venue as well. Vegas, of course, a little closer for me coming from California, so that was nice. Only a 1 hour, 1.5 hour flight. Anyway, the conference itself was great as usual. There was a lot of very informative panels covering every corner of the ETF industry, as well as the broader asset management industry. I sat on 7 or so panels, and I talked to a lot of industry people, issuers, journalists, folks on the research side, and things like that. Overall, it was, great to get out of the house. I work from home every day. So it's nice to mingle in person with the people I usually talk to on Zoom or on the phone.
What was the mood there as you were going around? Was it upbeat, a little concerned about the industry, about
Yeah, I think overall the mood was very optimistic when it came to the industry itself. Everyone was talking about how we're now at $10 trillion in assets under management in ETFs, and we're going to hit $20 trillion before you know it. There was a panel talking about the next 10 years in the ETF industry, and it took decades to get to where we are today, 10 trillion, but the prediction was that we could hit 20 trillion in the next 5 years. So it seems like this industry is accelerating. But that said, there was a lot of uncertainty when it came to the current macro environment. One of the panels that I sat in on, it was given by David Kelly, who's the chief global market strategist at JP Morgan Asset Management. And he basically talked about everything that we've been discussing on this podcast week after week, which is the tremendous policy uncertainty that investors are grappling with right now because of the tariffs, essentially. He said that these tariffs are like a policy fog that's hanging over the markets.
wow,
Overall,
policy
yeah,
fog? That is a great
yeah,
way
I
of
like the
putting it.
way he phrased that. He said heading into 2025, things were great for the economy, right? We had 2.5% GDP growth, inflation trending towards 2%, unemployment at 4%. But that's kind of all being challenged now by these tariffs, which in his view could push growth in Q1 into negative territory. That
Well,
said, he does. Sorry, go ahead, Paul. I
no,
know.
good. I just wanted to put a pin in that tariff conversation for
Yeah.
later, but and come back to it. But go ahead, please continue.
Yeah, yeah. So obviously, growth could be negative in his view, right? Not everyone believes that. But that said, he doesn't think the Fed is going to come to the rescue. He thinks the Fed's probably going to end up cutting rates at most once this year. And that's because, we do see these tariffs putting pressure on the economy, but he also believes that maybe later this year we could see tax cuts, and that's going to push the economy the other way, maybe re-accelerate growth. So the Fed just doesn't know, right? You have all of these tailwinds and headwinds competing with each other. So he doesn't think the Fed's going to try to predict what's going to happen. It's just going to respond to what actually happens. And given all that, his advice for investors is to stay diversified, maybe consider international exposure, and also look at fixed income as a ballast in the portfolio. He sees good opportunity there with yields still relatively high.
And you also attended a panel on crypto. What was the big takeaway from there?
Yeah, that was a really interesting panel. And the big takeaway, I think, is that we're in this new era when it comes to crypto and ETFs, right? We know this administration is going to be more permissive when it comes to crypto, or at least we think it will be. And but at the same time, this SEC probably isn't just going to allow any type of crypto asset to be put into the ETF wrapper. We assume there's going to be Solana ETFs, XRP ETFs, but the question was asked, is there going to be a Trump token ETF? Is there going to be a Melania token ETF? And the panelists didn't seem like they thought the SEC is going to be that permissive and allow those meme coins into ETFs. So they were bullish on that, but they think that it still remains to be seen where the SEC draws the line when it comes to these crypto assets within ETFs.
More importantly, I think we're all really curious to know, did you try your luck at the tables while you were there?
Yeah, I did go to the roulette table, lost $25 in about 30 seconds, and that was the extent of it.
That's me. I go in with $25, but as soon as it's gone, I'm out of there. But
Yeah,
my
exactly.
favorite casino is on Wall Street. Okay.
Right, just buy some meme stocks instead.
There you go. Actually, your discussion of Bitcoin leads me to Kent, who earlier this week you wrote about the gold ETF, GLD, and I feel like there's a little bit of a segue here is um, there doesn't appear to be any data indicating a recession, yet investors are pouring into gold and gold ETFs. It's a long time safe haven. Now, sometimes people have talked about crypto being a possible complement to gold as a safe haven, but I'm not sure if I see it. But anyway, it feels like people are trying to protect their portfolios. As a financial planner yourself, what are you seeing and hearing, and how's the mood out there when it comes to GLD and other asset protecting type ETFs?
Oh yeah, yeah. Good questions all. I mean, I would say, you put all the reasons for potentially investing in gold or GLD, gold ETFs. There's at least four, and all four of them are in play now. And so you throw your dart at the wall and pick which one. I mean, it's gold is considered an inflation hedge, although the data on that is mixed, but still the perception that there could be inflation because of tariffs and those type of things is driving the price. Uncertainty, of course, you mentioned the safe haven. Anytime, there's a lot of uncertainty in the area. Samit talked about the fog hanging over. That's uncertainty. Recession. Now, like you mentioned that there's no obvious or data saying we're going to have a recession, but the fears are still there. Consumer confidence at multi-year lows. But the big piece of it is weak U.S. dollar. So the fact that the economy is slowing does increase the odds that there'll be rate cuts. There's kind of a question as to whether, like Sumit said, there's going to be one rate cut this year or two or three. The data will show us. But anyway, the rotation out of U.S. stocks, a lot of people don't think of it that way in terms of weakening the U.S. dollar. But whenever you're pulling assets out of U.S. dollar denominated investments and putting them into other ones, you're basically taking money out of the United States and putting it elsewhere, which pushes the dollar down. Now, a weaker dollar makes gold more attractive. So in the article that I wrote this week, I mean, I don't even know if this is a term, but maybe I'm making it up now, and it is one. But I call it the gold price weak dollar feedback loop. So it's investors rotate dollars out of U.S. investments, which pushes the price of the U.S. dollar lower. That makes gold even more attractive. And so, why do people buy gold? Well, sometimes it's just because gold is up. I mean, it's kind of like the gold rush, right? People were striking gold, and so everyone went out west where Samik lives, and they're out in California, and they're digging for gold. And so we talk a lot about ETFs when they're at all-time highs or assets. Gold at an all-time high. Right before we jumped on this podcast, gold all-time high. It's over 3,050 right now. So that creates more buying. Now, arguably, now you're talking about I'm a financial planner. A good time to look at investments is when they're low. I mean, I mentioned gold as an inflation hedge also. If we look back at, say, 2022, the price of gold was mostly down that year, and that was the year where inflation was its highest. When did it really start pulling back up? October of 2023, when the Fed was done raising rates. And so if you bought back then, you're up at least 50% now. I think it was around 1,800 back then. So my message out there, not advice, but just general good rules with diversification. You want to buy more when prices are extremely low. Right now, arguably a better time to sell. When we hit that 10% correction, and some of my client accounts that holds gold, GLD or GLDM rather is what I usually use. But anyway, we were trimming off some of our winnings, if you will, with gold. To use a Vegas term, we're taking some of our money off the table and we're putting it elsewhere.
So I've got a follow-up question on that. So I was going to ask you if it's time to batten down the hatches or going a buying spree with a fire sale right now. It sounds like you're saying buy, take advantage of the discount. So if you were, are there any specific ETFs that you're looking at during this period of time?
It's a really a much better time to hold than to buy or sell, in my opinion. I mean, even with my retired clients, a lot of their assets are earmarked for long term, and so we're looking at different buckets. So right now is a great time to be in, say, ultra short term treasuries for your short term bucket, if you will, and even some of the intermediate term, like Sumit was mentioning. It's a good time to use bonds or bond ETFs as a ballast. But long term, I mean, we're publishing today, or actually it's going to be yesterday when everyone hears this, an article on AI ETFs. I mean, so if investors want something long term, it's never a bad time to buy. And so we just passed a correction. So if you've got a lot of ETFs that have done very well over the last handful of months. It's not ever a bad idea to trim off, classic rebalance, sell off some of your winners and buy into some of the losers. So right now, something to buy, nothing's jumping out at me. I'm not Warren Buffett, but I'm patient.
Not all of us can be, unfortunately, Kent.
No. I mean, there's no screaming values out there. And again, it's all about uncertainty. I'd rather kind of wait until that fog lifts that Samit was talking about.
Yeah. And Ken, to touch on what you mentioned about gold being high, it does seem to have this pattern of running up a lot and then kind of flattening out for a while and then running up a lot again. If you look at the gold chart, you can see that there was a big run up during the COVID times, when the Fed was cutting interest rates down to zero, QE was unleashed. There was a huge rally in gold all the way above $2,000 an ounce. That was a record high at the time. But then, we got that huge inflation in 2021, 2022, and gold never made new highs. It was just kind of consolidating. And it took about 3-4 years before gold broke out again. And that seems to be what's happened over the past year. We've seen this big breakout. Gold has now had two tremendous years, is up 27% last year, up another 17% this year. It's almost doubled off the lows of 2022. So I'm not saying go time the market. Now is not a great time to buy gold, but just keep in mind that gold tends to have this pattern of making big moves and then kind of flattening out. And maybe you might want to consider that when you're trying to add gold to your portfolio and things like that.
Mean reversion. I mean, if you look at the historic, say, average return of gold, I mean, it's going to be right around inflation, 3% or so. I mean, and if we're up 50% over the past 2 years, that's kind of cautionary to me.
Meanwhile, this leads us to copper, which is saying to gold, hey, hold my beer. So, Ron, you wrote about the copper ETF, CPER, which is at an all-time high this week itself. So what's driving that?
Yeah, I mean it's also saying to Nvidia and US stocks hold my beer, or in the case of other tariffs, hold my cognac. Um, so yeah, yesterday copper jumped. There was a Bloomberg report saying that plans for tariffs are being accelerated, 25% tariffs on all imports of copper, which, pick up your phone or whatever, you've got copper within inches of you just about wherever you are at any time. So, um, so yeah, copper reached an all-time high. And the copper ETF CPER also jumped to an all-time high. Interestingly, there's also a leveraged, copper ETF that also jumped yesterday. Now they're kind of giving up their gains today, but you know, copper or CPER is up, like 30% this year. It's been, just through the roof. So somebody, I don't know if it's the consumers who are excited about copper tariffs, um, but somebody is doing well. And of course, copper is such a critical component to so many things. I mean, it dovetails or kind of feeds the inflation recessionary fears, right? I mean,
Well, would you say
it's
that there seems it feels like with gold and copper that, there may be a return to valuing tangible assets, like precious metals, as opposed to crypto. Would you say that that has any play here?
no, no. Well, copper had been copper's it had been in a glut, I think, a few years ago. So this is playing into that too.
Oh
So
yeah. Well, if you think about where CPER was a year ago, I mean, it was down
yeah,
in the dumps, and it's made a tremendous comeback over the past 52 weeks.
This is over my head because I don't look at, I'm not a trader in this regard, but I know that some of the professional traders, if you will, institutional, are looking at a copper arbitrage. And so the rising price of copper on the COMEX exchange in the US is not being matched on exchanges in London and Shanghai, for example. And so that creates an arbitrage opportunity where it's almost like free money. So maybe some of those institutional traders are driving it, or they
mm,
definitely are to some degree.
yeah,
But then you've got some of the more maybe between amateur and pros looking at just the momentum for the price, and it's kind of like the same thing as I was talking about with gold. It's going up, so nothing attracts a crowd like a crowd, right? I mean,
well, there does seem like there are still some, like it's going to go higher, right? I mean, it's what, like $5 right now, the futures. And I did see one report from the FT, a headline saying they're expecting $12,000, or traders are expecting $12. Whatever, I guess you have to check the futures, but just a magnificent surge in copper through the end of the year. So it looks like the play or the
Yeah.
bet has got legs. So,
So if that's
and
12,000, Ron, I think they're talking about the London price, which is currently around
yes,
10,000. So another 20% upside or so.
yeah,
And yeah, like Ken pointed at, essentially there's this big gap. I think, I don't know if it's a record high gap or the highest in a long time between the London price and the US price for copper. And it's essentially because of these tariffs. Everyone's trying to import as much copper as they can into the US before these potential tariffs hit. And
yeah,
this
And
copper, which we're talking about, CPER, it actually holds the US futures contract. So it's benefiting from this huge surge that we're seeing in the US copper price. And we're seeing a rise in the London price as well, but not as much.
I was going to say another benefit is people investing in Chilean stocks. So the iShares Chile ETF with the ticker ECH has had a very solid year, 23% gain this year, because Chile is the world's biggest copper exporter.
as I was just about to ask, that,
Yeah,
so thank you for clarifying.
for
Uh,
sure.
Sumit, you mentioned the tariffs, and that's a perfect segue into our final topic of the day. On Wednesday, President Trump announced adding a 25% tariff on foreign-made vehicles, and that seems to have roiled not only car manufacturers, but markets in general. Now, our colleague, DJ Shaw, is writing a story on this as we speak. But in the meantime, if it goes through, how does this, how does this, how does the average ETF investor play this development if the administration does indeed follow through with this on Tuesday, April 2nd? I open it up to whoever wants to answer first.
Well, obviously, speculating on tariffs is an aggressive strategy, right? The headlines are changing day to day, minute to minute. But there is one ETF that seems almost tailor-made for this current scenario, and that is ELON and Elon. It's a Defiance Battle Shares Tesla versus Ford ETF. It launched back in February, and it was essentially it takes a leverage long position in Tesla, 2x leverage long on Tesla, and pairs it with a 1x short position on Ford. So you're essentially betting that Tesla will perform better than Ford. And we're recording this on Thursday, and it's really benefiting from this latest headline on the tariffs, auto tariffs, because this ETF is up something like over 10% today, and it's sitting at the highest level since early March. And presumably, all the automakers are going to get hit by the auto tariffs to some extent, but Tesla might be the most insulated because it makes the majority of its cars in the US, though it does import some of its parts from outside of the US. It's unclear, whether these tariffs are just going to apply to the finished cars or are they going to apply to the parts? Because if it's just finished cars, Tesla makes most of the cars that it sells in the US. But I've read that
But
it
the parts,
imports.
but the parts come from all over the world, and
Right,
those are
yeah.
already subject to tariffs. So now you've got tariffs upon tariffs.
Exactly. But even assuming that's the case, the parts get hit with more tariffs as well. Tesla gets the least amount of parts from foreign countries. I think it's something like 25 to 30% of its parts it imports. The rest it makes in the US. So it's still better insulated than all these other automakers. And I think that's why it's outperforming today. This, out of all the automakers, is best positioned to weather these tariffs. And, if we see the price of foreign cars go up, maybe that makes Tesla cars look more attractive to consumers, right? So that's also a factor. So this Elon ETF is a way to bet on that. Again, very aggressive way to bet on it. It's essentially a leveraged ETF, also an inverse ETF. It's a pair trade. So I don't know. I wouldn't say the average investor obviously should not be looking at this type of ETF, but if that's something you want to do, it's out there.
Yeah, you also have to remember that there's no member of the Ford family that's on the Doge committee. So
Something to look at also is the law of unintended consequences. And if you look at basic supply and demand theory, if you put a 25% tariff on foreign-made vehicles, then with the intent of trying to get people to buy more American-made vehicles, that those dollars start chasing a product that may not be ready to handle the influx of more buyers, thus driving up the price. And then you have a across the board increase in auto prices for everyone. Potentially that could be a boon for auto manufacturers as opposed to a liability. It remains to be seen how it plays out. But when it comes to this administration, I would bet on the law of unintended consequences over meticulous planning. So
Yeah, we'll definitely see what happens. I've also read there might be a mix shift within the auto industry. The more expensive models, bigger models of vehicles might, be better positioned to weather these tariffs. They're already expensive, so maybe the consumers of those type of cars won't feel the impact as much as these cheaper models of cars, many of which come from overseas. That's where you're going to see the sticker shock more.
For sure. Well, I think we've covered exhaustively a lot of topics this week, and I want to thank the panelists this week, Kent Tooney, Ron Day, and Samit Roy, for joining me here. And I want to thank you, the listeners, for taking the time to stream or download the Exchange Traded Fridays podcast. Remember, if you haven't already, please subscribe and follow us wherever you get your podcasts. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly Twitter. Our handle there is @ETFCOM. We'll be back next week and see you then.